So welcome everyone, welcome to this webinar, how it starts and how it ends. This is the Thursday, the 28th of April. So quickly going through my background, started in 2000 as a cash equity trader in Paris, working for a company called Pierre Charon Gestion. Then I moved to London in 2004. Where I worked for a hedge fund from 2004 to 2008, where we were managing on the Western European team, 600 billion plus. The overall company was managing 2 to 3 billion. In 2009, I joined Infinity Capital Market, where I was a prop trader, no constraints. Worked there for 9 years. I left in 2018. Since 2014, I've been doing mentoring. So I mentor more than 100 people from all over the world, retail traders mostly. And I launched in 2019 the 4x4 video series, which gives you an investment process. At the start of last year, we started with Infinity again, doing the same that I was doing for years and years. So this is from my background. So what are we going to be covering today? As usual, we're going to be talking about the situation across asset classes. The last time we spoke was a month ago. So since then, a lot has been happening. We're going to be talking about the recent sell-off that we've seen across asset classes. So really risk off. Stocks have been hammered. We're going to be discussing China. Why? Because as you know, China is in a total lockdown. Full lockdown almost, so it is impacting the markets and the economies. And then we're going to be discussing earnings as we are in the middle of the earnings season for Q1 2022. So last time we spoke, as I said, was a month ago when the market was really bullish. S&P 500 was at 4,500, strong market. As I told you, I was a bit cautious for several reasons. Since then, we have been coming quite a lot. So we went for very quickly from 4,500 to 4,150, 4,200. So I told you I was a bit short. I covered my short. I covered some of it at 4,300. So 2/3 at 4,300, 1/3 at 4,200. So now I'm actually a bit long the market. So that's for the equity. And as always, I didn't put the disclaimer. This is you should do your own work. So this is not because I have a position that you should be doing exactly the same. What we have in terms of market conditions have been really bad. So most of the time we are looking at the equities, mostly stocks. We're going to be discussing a lot about FX, currencies. So the dollar has been extremely strong, which is complete opposite of some expectation that we had a month ago. So that put everything into perspective, and actually that tells you that in the market you're gonna have some bad trades, and sometimes your hit ratio, and very often your hit ratio is going to be lower than 50%. So we got the Ukraine war, we got China in lockdown, we get potentially a European recession coming. Earnings season, as we're going to be covering, is okay but not great. So commodities, shock supply. So from all of this, the US economy is just doing okay. So today, as we're going to be covering, we had the US GDP. And most importantly, we are getting closer to the FOMC meeting that is going to be running next week. So very important. Expectations are for the Fed to increase, to hike rates by 50 bips, to talk about a lot of inflation, a lot about quantitative tightening. So a big move on the US dollar. So let's start by talking about the asset classes performance year to date. So you know the style now. So that was as of yesterday. Now live the market is up 2% from this level, 1.5 to 2%, as the S&P is at 4260. But you get roughly the picture, which is the S&P down roughly 10%, Nasdaq roughly down 20%. A lot of developed markets have been suffering. Same with China. So China down 20% and is making new lows And as we're going to be talking, China is trying as much as possible to limit this downside. But really the second part of which is really interesting is this part, which is the currency. And we can see that year to date, the US dollar has been really strong. So it's up 7% against most currencies, 12% versus the dollar yen. So the dollar yen today was at 131. The Bank of Japan this morning said, you know, guys, we're going to carry on of what we have been doing. And as we explained before, you get the carry trade, and as well, by definition, you get the differential of rates and expectations. So that explains a lot. First, this differential in rates expectations in the next 3 to 6 months, why the dollar has been so strong. And in the meantime, you get a flight to safety as the dollar becomes the king dollar, and everyone wants to be long the dollar. In the mid to long term run, as we discussed a month ago, the dollar might be suffering from those conditions. As well, the balance of payment, the balance of trade, yesterday was pretty poor for the US dollar. So there are some key elements that are not that strong, the dollar. Having said that, that has been the price action. So week to date, so since after the Easter weekend, from the Monday onwards, I think it was from the Tuesday. So actually, once I started to come back from holidays, markets really started to sell off heavily. So we went from 4,500 to 4,150 on the S&P. So you have really a risk off for stocks on 5 to 7%. That was, as always, let's say, even stronger based on due to options. So now the moves, when you start to move away from the gamma neutral, you have acceleration in the sell-off. Plus, as this is a market for this year that has been very much trending across asset classes, the CTAs, when they start to be in control, that similar increases the move. But here, in terms of move, really the US dollar between 3 to 5% on a week-to-date basis. So that is pretty much the 0.1% move that you should be normally expecting. So really big move on the currencies. So the macro world has been moving really deeply, and that is affecting all the other asset classes. So in terms of performances by sectors, picture is more or less the same on the year to date, 35% for the energy, and almost every sectors that are small flat to negatives. On the week to date, you can see that actually everything was done. You get a bit of defensive with the consumer staples here, which were only down 2.5%. But really what was interesting, if you look at the performances of industries and sectors over the last 5 sessions, X today, is the winners of the year really underperformed the market over the last 5 days. So what does it tell you? There was maximum pain in the market. If you were making good money with some energy, some commodities, actually over the last 5 days, you suffered a lot. So market has been forcing most market participants to reduce exposure. So gross exposure could have been extremely painful. Bonds, so the US 10 years around 2.8%, but what we've seen, and you know it already because you're following the news, for the last 4 months, there has been a massive sell-off in bonds, and that's across countries. If you put aside Japan. Why? Because we do have a lot of inflation, and as we have a lot of inflation, we are expecting central banks to be more occasioned to increase rates. The VIX, as of yesterday, was at 30%. Now it's below 30%, so it's a pretty high level. Very curious market from last week when On the Monday, just after Easter, we went from 25% to 20% intraday, and then from the Tuesday onwards, we started to go higher on the implied volatility. So literally the last couple of weeks have been extremely curious, very abnormal moves, a lot of pain for many investors. Let me jump now into the technical analysis. As always, starting with the S&P futures. So the S&P futures, this is a chart that we discussed before. So you had this trend. We had this squeeze. Always hard to find the top on the squeeze. So that means if you get a short bias on the squeeze, obviously you need to start with slowly. Don't go 100% from the beginning. So you need to do 10%, 10%. But overall, now we have been testing these lows, this trend that we have here. I was still targeting on many fundamentals 3,900, but between now and the 3,900, I think you don't need to be that doom and gloom. So trade the market. As I said, I probably closed my hedges and my short between 4,200 and 4,300. So that should be around 4,250, 4,260. So I'm close to those levels. I didn't want to go into the Fed, short the market. And I think a lot of asset classes have been, and stocks have shown too much of a sell-off. So that's for the S&P. If you look at the NASDAQ futures, the picture is more or less the same. So we have these bonds now, which is the chart is not as convincing as the S&P, but it tells me that being neutral, this market at this level is probably a good idea. I'm a bit long now, to be honest. Let's look at the Russell. I don't like the chart of a Russell. So far, that this is one of the charts that I really don't like. I've been saying that for quite a long time. It feels to me like there is some downside. So in other words, stocks that have companies that have more exposure to the US, to me, could be underperforming companies that have less exposure to the US. So 4280 now on the S&P. This is a proper squeeze now. Let me what I wanted to say, that was for some sectors as well. So quickly looking at the KBE. So that's for the banks in the US, getting closer to an important support. Let me give you a longer chart. So this is, you have potentially 2% downside from here. Looking at another one that obviously is making the headline is ARK versus the SPY. So ARK, which is long all the dodgy stocks in the world. We are talking TDOC today. So if you look at what they are owning, it's just a farce. But what is interesting, if you go back in time, that tells you that actually ARK is now barely outperforming the S&P since its creation. So a lot of noise for not much. So the disruption has not been really coming. And I don't think this is only a question of disruption, but this is as well a question of how to pick stocks. So it's one thing to say that you are disrupting and companies will be disrupting. That's another thing to be a stock picker. Some chart to give you as well. An interesting one is Pepsi. So defensive story. You can see how strong those stocks have been. So if you look through the XLP and some other industries, you will find some of those names, some interesting charts. Another chart that I've been deeply monitoring is United Airlines. So United Airlines, I think this one is a beauty so far. So bang, 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 and then it goes back into the support. So if you believe in the economy restarting in the US, I'm talking about the economy reopening post-COVID. This is obviously one of the themes to play. Quickly, as well as I discussed, I think we should do a bit more than usual. So this is the euro dollar now. So euro dollar now is really close to the lows that we had over. Let me give you a longer chart. Let me give you weekly. So as I told you before, I thought it was a good long here, there, but my stop was there. For the time being, you know, price action is really strong dollar, so there's no point going against it. We are going close to an important level. This is, if you look at the second one, which is literally the destruction of the Japanese yen. So we are at 131, but you see the move that we had over the last six weeks. We are talking 10% move against the Japanese yen. That is really big. So there has been a flight to the US dollar, meaning there has been a lot of extreme positioning going into this Fed meeting, similar to the DXY. So the DXY, for those of you looking at the US dollar, obviously as an index, don't forget that between 55 and 60% of the DXY is only the replication of the euro dollar. Okay, so that's more or less the same, but you can see as well that we are getting close to extremes. Why it is important to look at those extremes is because central banks are looking at effects. So even if they said that they don't want to intervene in most of the time in the FX market, actually the Bank of Japan said this morning that they might be ready to do something. You could have, if the dollar get too strong, I think some central banks sitting together, especially I don't think that will help the Biden administration if the dollar is too strong. That helps the euro in the short term, and that's obviously an indication that the European economies could go into recession. So let's go back now into those slides. Let's carry on up. So let's go into the next slide. So that's the asset classes performances for the industries for this month. As we see here and as we discuss, you know, US dollar very strong. 4 to 6%, 4 to 5%. So this is not an industry, this is more an asset class, and I put, you know, the wrong title. At the other end of the spectrum, you literally have huge move, 10% plus on the downside: internet, online retail, cloud, solar. So all those sectors, all those industries, should I say, were the ones that were on fire in 2021 until November, but you still get a massive sell-off. And again, what was really interesting over the last 5 sessions, if you look at those industries, you know I like to do this style, is sectors, industries like gold miners, metals and mining, oil services, steel, healthcare, really underperformed the market. So again, that is a tell that there is big pain in the overall market, that everyone that's got growth exposure is suffering. So quickly, a bit of macro, looking at the US GDP. So I think it was 2 months ago I did this aggressive title on one of the webinars saying that there was a 50% chance of a US recession. So now we got 1 quarter. The definition of the US recession is you need 2 quarters in a row for being called a US recession. So we are halfway. So today the US GDP minus 0.4% quarter on quarter, which gives you minus 0.4% on quarter annualized. If you are subscribers of the 4x4, or if you get access to the community now, you know that actually those numbers are not as bad as the headline is telling us. Why is it negative is mostly because of exports, which can be explained by the world slowing, and as well by the GDP, the part of the GDP that is coming from the governments. But other than that, investments were okay, and the US retail consumer was still okay. So not such a bad number, but that still tells you that the economy is not firing on all cylinders. Going into the next slide, talking about something that is important, obviously, is we get next week the FOMC meeting. So the outcome is going to be on Wednesday. Last time we had the FOMC meeting, I think between 2 days before and 2 days after, the market moved up. The equity market moved up by 5%. So what we have from these expectations, it's a done deal that we should have 50 bips. Then we're probably gonna have 50 bips in June as well. What's gonna be key is what the Fed is gonna be saying during the call after. Powell, what is he gonna say about inflation? What is he gonna say about yields, Fed fund rates going forward? Even the US dollar, because at 105 versus the euro, after a 3%, 5% move in less than 2 weeks, you can be sure that there will be questions around it. But for the time being, those are the expectations for next week. Very quickly, this is how I titled this webinar today, to tell you that sometimes we make mistakes. So a month ago, we looked at the potentially end of the US dollar hegemony. So this is how it started. As I said, in the mid to long run, it feels very much like the part of the US dollar in all the trades should be coming down. But for the time being, we are talking about how it ends, which is the strong move of the US dollar. So here, this is the DXY that we looked before. So we are making new highs, very strong dollar. Similar to how it starts today, should I say, on the 10th of February, the Bank of Sweden, the Riksbank said, you know, we're going to have potentially higher rate hike in the second half of 2024. And how it ends today, this morning, they announced that they were raising key rates by 0.25%. So in other words, the last couple of months, there has been a lot of changes between how it starts and how it ends. That's the same with something that we have been discussing over and over, which is the S&P 500 seasonality and how normally the flows are. A month ago, we looked at how the S&P is doing roughly during this month of April. On an average, it was returning 2.5% with very few little negative months. So that's how it starts and how it ends. This is the picture that you had as of yesterday, where the market, the S&P, was down 8% for the month. So now we are only down 5 to 6%. But it tells you something, how it starts and how it ends. That is very different. The outcome is the past performance is not an indicator of future results. So that has been really something important over the last month, or should I say the last couple of months, is many of the scenario that we had in place went down the toilet and went down in flame very quickly with a lot of pain, with extreme moves after our stop losses. So now looking at the risk off, so here we got the picture of the euro dollar and looking at the 1 month euro dollar move. As you can see over the last 2 years, this is a very significant move. I mean, I repeat myself over and over, but you know, most of the time we're gonna have 60, 80, 90% exposure to equities. Sometimes we're gonna have a bit of exposure to FX, and it's all as well having an understanding of FX to create and to generate ideas for stocks. So really big move, this risk off. So here we got the euro dollar, but that's the same with the dollar yen. That's the same with anything against the dollar. Dollar is up 5 to 10% against any currency. So if your salary is in US dollar, this is a good thing. If it's not, then you might be suffering. And for instance, that people who like to buy the 4x4 in dollar, that could be a bit painful as well. So here where I'm looking at the US industry's performances, year-to-date moves. Look at this year-to-date move absolutely huge move. On the 1 month basis, we are talking almost everything that is down, and we are talking double digit for many of these industries. So this month, you know, it's not, maybe the sell in May go away was a month earlier. That tells you of the strength of this sell-off. What I like to be looking is how the different stocks have been behaving, and here I'm looking at the percentage of members of the S&P that are trading above the 50-day moving averages. As you can see, we are getting closer as of yesterday to the level that we had in September, October 2021. And we had at the start of this year. So there is a bit of downside from those metrics, but not a lot. That's the same picture for the Nasdaq composite, with the percentage of members trading below above, sorry, the 50 days moving average. Only 23% were trading. So in terms of short-term momentum, because we are talking 50 days, really that has been quite a huge sell-off. So quickly now jumping into China. So the China, you know, you've been reading the headlines. China has been in total, started the lockdown at the start of this month. So that's something that we started to discuss very early in the community. So now what we've seen is a lot of investors have been putting their money away. So a lot of outflows out of China. It started 2 or 3 months ago, or accelerated with the ADR stories with Alibaba and some others. But there is a sense of a bit of panic in China, where even today there were talks about the potential infrastructure plan in the near future, which, to be honest, I'm not a Chinese expert, and I'm following the guys that are really relevant. It seems to be absolutely pointless. They have done it in the past. They don't need infrastructure anymore, but they try to find ways to restart the economy. But how can you be restarting an economy if you decide to do a zero COVID policy? And here we get the daily new COVID cases in China. Again, those are all I don't know if you remember all those chart graphs that we had 18 months ago, 12 months ago, looking at the Google, and now it's hopefully over for Europe and the developed markets. But China, why is it important? Because this total lockdown is affecting a big chunk of the Chinese economy. So this chart is from SocGen, where 80% of the Chinese GDP is affected by this lockdown. So first, that affects the Chinese economy. So if we look at the Chinese economy, you know now that the Chinese GDP makes up between 15 to 20% of the world GDP. This world, it's not looking good on that side. If you add the 15-20% from the European GDP, that puts you already at something between 35 and 40% of the world GDP that is struggling right now. And that's going to be potentially struggling in the next quarter or this quarter. Why? Because the war in Ukraine is not stopping, is probably not going to stop overnight, unfortunately. And this Chinese lockdown is not going to stop overnight as well. So you got 40% of the world GDP that is potentially in recession. And as well for China, what is more disturbing, maybe it's a big word, but what is troubling is we know that the world has been struggling a lot from this Chinese and the supply chain issues. So that means it's not going to get better, or it's not going to improve in the next 3 months. We are talking we are talking things like everything down your supply chain that you'll be using from China. I'm thinking semiconductors, for instance, that will be really affected. So really that is a concern for the rest of the world. Here we get another chart that I'm using from Bloomberg, which is the China Industrial Port Index. So really China is facing a recession over the next quarter. It's going to be affecting the rest of the market. What was interesting is actually took a bit of time for the Chinese yuan, for the renminbi to weaken versus the US dollar. So this is something that I tweeted last week when we started to book the 630. Now we are at 665. So if you think about the move, we are talking 5 to 6% move on the Chinese yuan in less than 10 days. So that is a very, very significant move. Normally, the Bank of China, the Bank Popular of China, is always controlling the Chinese yuan. Now it's going quickly and weakening quite quickly. So there are talks that, you know, what about if it goes to 7? We are not there yet, but it tells you again that due to the lockdown that is closing a lot of those Chinese provinces, we get this GDP and we get the Chinese yuan that is under pressure. So some trades to be looking at. So this is a chart that I like very much from JP Morgan, which gives you the correlation between the renminbi and the European stocks with high Chinese exposure. So obviously you were talking luxury, we are talking Kering, LVMH, a lot of European stocks, but we are talking as well some of the German automakers as well. And if you look at this, the same chart, so in white here, this is the USDCNH versus the SXP, which stands for the stock 600. If you believe that the Chinese yuan could weaken, that is a very negative for Europe. Why? Because Europe is exporting a lot to China. China is a very big customer of Europe. So this is one of the trades that you could be putting in place if you think that you don't want to go through FX, or if you're better off doing with European trade. And the one that is really the elephant in the room, this is the USD versus the Hong Kong dollar. So for those of you who are not familiar too much with FX, so the Hong Kong dollar has been pegged to the US dollar since I think it's 1983, and it is sorry, the two barriers are between 775 and 785. So now there are question marks that even if the the central bank of Hong Kong does have a lot of reserves, because as one of our subscribers in the community flagged, they have something like 500 billion, so they can defend this peg. But how long can they do that on the eyes of this weakening of most currencies versus the FX versus the US dollar, of the CNH weakening, of this lockdown that's going to be lasting longer than usual? So these trades or this idea of a trade, and because, you know, the peg has never come down yet, but you imagine the potential effect on the region, so that will have huge effect on the whole Asia, and more importantly, I think the positioning, this peg has been around for almost 40 years now, so you can imagine the size that we are talking if it breaks. So this is typically, if you are in a hedge fund, if you are a trader, those kind of trades that you'll be looking at. What is your downside versus your upside? And obviously you are looking back at what happened to the Euro Swissy in January 2015. So something that we are almost talking every single day on the community. I think this is the kind of trades that are interesting. Again, I'm not telling you to do anything. I'm just trying to bring you ideas and to put you ideas like how people or how traders are thinking when they try to generate ideas. Earnings season, quickly looking at the Q1 2022. So here, this is an interesting chart from Bloomberg about the city earnings revisions. And as we can see here, March and April, there has been quite a revisions done for the earnings. So that is for the US. So sorry for the noise in the background if you hear that, but the trend has been quite done, and some acceleration and revisions down for the earnings. This chart, which comes from very good analysis done by JP Morgan today, and it's so in gray you get the 3 months EPS revisions percentage, and in blue the year-on-year change in the MSCI. As you can see, when earnings are revised down, markets will have negative returns. I mean, it sounds pretty obvious when we say it, but as we know, and as we had recently earnings revisions down, that explains a lot why the equity market have been really struggling. So when the consensus EPS revisions are falling globally, so that's the bars in chart, Europe ex-UK, and that is more for the ID generation, tends to underperform the USA. And JP Morgan is flagging that the opposite is true when obviously EPS revisions are rising. So, you know, when I was building the 4x4, I spent a lot of time on this correlation between market and earnings. It is pretty obvious that in the long run, what is driven the equity market are the earnings, and how the earnings are growing, and as well what is the trend in terms of earnings revisions or earnings growth. So based on that, what we had recently is we've seen a lot of earnings revision down from February onwards. Obviously, one of the first reason was the war in Ukraine, which affected mostly the European market first, but as well is affecting world economy. And now we get the Chinese economy that is in lockdown. So over the last 3 months, as you can see here, we have seen some earnings revision coming down, energy based on oil going through the roof. We've seen earnings upgrades, but overall the picture is the following. As we have earnings revision down, we see the equity market coming down. Okay, it's not like there is some funny reason to that. And I've been almost every webinar that I've been doing, I've been explaining, you know, how these earnings are working, what are the expectations, what is the growth versus history, do we have some revision. So this earnings season, if we look at the earnings move on the day, that has been very interesting as well. So that's a very similar chart that I used I think it was 3 months ago, explaining the moves, the return on the earnings day. So this big move, this minus 35%, this one is Netflix, but you get roughly, let's say 200 stocks, and I'm talking 200 S&P 500 components. So the average daily return has been almost minus 1%. Median daily return minus 0.5%. So you can argue that during these months, the market was mostly down. So actually, this is not absolutely shocking. But what is most interesting is the average daily move from all these stocks is at 4.1%. And I read somewhere that this 4.1%, I think it was Goldman Sachs said that it was the highest since Q4 2011. So really what has been interesting over the last 2 quarters, something that we've seen before as well, is normally the realized volatility, meaning the move on the day of the stock, is lower than the implied volatility move. Okay, so if you go through the options market, you will see that, for instance, the stock is supposed, let's say, to be moving by 15%, and normally, on average, the stock will be moving by less than 4 to 5 points. Okay, so instead, by moving by 15%, it will be moving by 10%. Why? Because we got a tendency as human or as investors to overhedge ourselves during the earnings. But what has been happening over the previous quarter and this quarter is stocks are moving more than their implied volatility. So meaning that if you were long, again, straddle, strangle, or strategies with higher volatility, you were making money. And that tells you first that the market is obviously much more volatile than last year. Okay, this is why you get the VIX between 20 and 35%. But when you have higher volatility, is because you have expectations that are fluctuating much more. So there is much more uncertainty. It's not like just the market is nervous because it just wants to be nervous. There's much more uncertainties in the expectations and what companies are delivering. So what are they delivering exactly? Yeah, this is something that I'm taking from Bloomberg, but again, you can do the same. There are some good free product out there. So out of 160 stocks of the S&P, that was as of yesterday, we are talking sales 67%. Beat the expectation versus 80% over the last 4 quarters. And for the earnings, 81% versus 83% over the last 4 quarters. So on one hand, you can argue that earnings, it's more or less the same as usual. What will need to be done afterwards, and I didn't do it, is by how much obviously companies are beating, because if you just beat by very little, that's just a game. But I think what you can see from this one, from this slide, is actually the companies on the top line, on the revenues, are not beating as much as before. So my view is still the same, and that's something, again, that I push a lot in the 4x4. In the long run, if you want company to be beating earnings, to have good earnings growth, you need to have good top line growth, good sales growth. And right now, at least for this quarter, companies are not beating the sales as much as before. So that is important going forward. That is even more important going forward, is because companies in the first quarter have been able to pass on price increase to customer. Okay, so if you look at many companies, they will tell you, so far we have been able to do it, but now they are telling us, oh, going into the next quarter is going to be much more of a challenge. So if you look at a big company like Nestle, I think it was this week or last week, they said it's going to be hard to increase prices. So you might expect our margins to be coming down. So you could have the double whammy of sales not growing as much as they used to, and margins to be feeling a bit of a compression. So I might sound like a bit like a broken record, because I've been saying a lot, and again, the same story about those margin compression. But those operating margins are extremely important for the valuation of the S&P. If you look at the S&P 500 operating margins, where in Q4 around 17%, historically they are 13%. So if you multiply your sales by 17% or 13% or 10 or 9%, obviously that gives you a very different EPS, and that gives you a very different level of the S&P 500. So the question of the sales, we have a bit of a color now, which is with the world slowing, with China in lockdown, Europe that is struggling, it's going to be hard to see GDP going that much. Okay, so sales are not going to be spectacular going forward. And the second part, which are the margins, is how much do you have leverage as a company to be passing on those margins, to those increase in prices to your customer.